The value of your fixed deposit in ABC Bank crashed by 95% at today's closing prices. Has your bank ever sent you such messages? Do you find the idea ridiculous? Well, not if you expect your bank to be completely honest with you and believe that it should worry about its own bankruptcy. Today, more than half the public sector banks do not have the capital to pay back depositors. Thankfully, this is not about 2024. I wrote this to Equitymaster readers back in 2018. Yes, the NPA position of several public sector banks back then was indeed scary. Left on their own, the banks would have to mark down the value of their deposits by 90 to 100%, simply because they never managed to recover the loans fully. The gross non-performing assets of public sector banks had shot up to almost 14.6% in 2018, when their private sector and MNC peers had the ratio at 4.6% and 3.8% respectively. But public sector banks are not alien to the concept of loan write-offs and government bailouts. Time and again, the entities have resorted to these. Rather, whenever the credit cycle tightens and non-performing loans spike, the government gets generous about bailing out the big PSU banks. So the vicious cycle makes a comeback every few years. There are also other reasons why the public sector banks typically get away with the NPA stress every few years. It's because the investors have very little memory of such stress. For instance, is your banker obliged to tell you about a possible crash in the value of your fixed deposits based on the estimated NPAs? Never. But on the other hand, a sharp fall in earnings estimate could be an ominous warning about the possible crash in stocks. Reminds you of the crash in small caps, doesn't it? The problem is that we think about stocks and fixed deposits very differently. We take it for granted that the stocks are perpetually at high risk, for the returns are not guaranteed. And the guaranteed return from fixed deposits makes us complacent about their risk, especially if the deposit is in a public sector bank. Now, over the last 6 years, the performance of PSU banks in India has improved dramatically. The focus on bringing down bad loans has brought the NPA levels to a multi-year low of 2.8% in 2024. The low NPAs have had a benign impact on the capital adequacy ratio of public sector banks, which is at 16.8%, and the return on equity, which is at 13.8%. So, the Reserve Bank of India, in its 29th Financial Stability Report released in 2024, declared that Indian banks are absolutely stable. The problem is that the Financial Stability Report is backward and not forward-looking. For if it were, the central bank should have warned about the fact that NBFCs are already complaining about over-leveraged borrowers. The September 2024 quarterly results gave away the stress building up in the banking system. Entities like Bajaj Finance and Piramal Enterprises pointed to the rise in non-performing assets for their tighter underwriting norms. Concerns are especially mounting after seasoned banks like Kotak Mahindra Bank and IndusInd Bank reported elevated stress in unsecured loans. The pain is more acute in NBFCs and small finance banks like Ujjivan Small Finance that focus on smaller ticket loans. Sharp rise in growth of unsecured loans like personal loans over the last 3 years was already a reason to get cautious about the possibility of NPAs, especially once interest rates moved up. Yet the regulator did not seem to be too worried about it. Back in 2018, 11 out of 21 public sector banks in India had NPAs higher or almost equal to their net worth. In an ideal case, their depositors should have been warned and the entities should have been wound up. Offering deposits in the garb of safe assets in near bankrupt entities is mis-selling. If this was the case with private sector banks, depositors would have at least tried to redeem them as soon as possible. But the PSU banks, with the blessing of the government, managed to keep depositors in the dark. So this time around, when the government is coaxing PSU banks to lend more to smaller enterprises, investors must get cautious. It is only a matter of time before callous lending and the burden of steep interest rates take a toll on credit quality. The memories of 2018 NPAs may be behind us. But it may not take too long for banks and NBFC stocks to get re-rated to the 2018 valuations if the NPAs begin dampening shareholder returns once again. Hope you like this video. Thanks for watching.